In this episode of the MSA Rental Market Update, we are looking at the Wichita Falls rental market for conventional multifamily properties. For those that don't know, Wichita Falls is not in Kansas, it is in North Texas. So you can see that the metro statistical area is drawn out right here by CoStar. This is a very small market. There are only 85 conventional multifamily apartment complexes in this market. You can see where it is in location to Dallas. Here's Oklahoma City over here. Amarillo, Lubbock, Austin is down here, and Houston down here. Okay, so this gives you an idea of where this metro statistical area is located inside the Texas market. It is right along that Texas. You can kind of see the Texas state line really faintly right here. Okay, gives us an idea where it is. Let's take a look at our filters so we can see, as usual, what we are excluding. And we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable. So if we look at location, you can see that we are in market, metro statistical area, Wichita Falls, Texas. Okay, so first we'll go take a look at all asset classes together in the analytics, and then we'll look at each individual asset class by themselves. So let's go take a look at our supply side snapshot. So here is the supply side snapshot for the Wichita Falls market. You can see that we only have 85 properties in this market, totaling 6,647 units. There are no units under construction. And in the last 12 months, 65 more vacancies have occurred than people that have rented in the market. The previous 12 months, 25 more units were rented, then went vacant. So that's why we have that negative 356.6% decrease in absorption. And we can see that through the vacancy. The previous 12 months was 9.2%. Today it is at 10.2%. It has received a year-over-year rent growth of 3.2%. We will see what it looks like quarter over quarter. As usual, we are not looking at the capital market. We are only looking at the space market. If we come down, look at the long-term occupancy average, you can see that this market likes to be stabilized right around 88% occupancy. So that is a 12% vacancy for those taking note. And we are currently sitting pretty close to 90%. So we are above that long-term occupancy average. So let's go take a look at the data so that we can verify and see where this market is going to show up on the market cycle chart when we get to the end of this presentation. So let's go take a look at the data for all three asset classes combined, class A, B, and C. So here is the rent analytic data. We are not looking at asking rent. We don't care what the owners are asking. We look at effective rent. If we look at first quarter of 2022, we will see that the rents were $790, went up to $800, up to $813, and seems to have stabilized at $813. I've stopped looking at January numbers. We have seen a lot of erroneous data. So we're going to stop looking at the January update, and we'll look back at the Q1 once we get into about 2 weeks into April. In the meantime, we are going to stay in Q4 of 2022. So let's take a look and see what deliveries and absorption tell us. We have no deliveries because we had nothing under construction. And as you can see, the renters in this market do not like these rents. We've got to go all the way back, except for this 19 absorbed right here. We got to go all the way back to second quarter of 2021 before we had any kind of positive absorption, except for this small number that happened in Q3 of 2022. So these renters have basically said, yeah, we don't like these numbers. We don't like these rents. And we have increased in vacancy, decreased in occupancy ever since. So the fact that we had, especially when we're sitting at 10% vacancy, the fact that we had continuous rents increasing all the way to 22 Q2, which stabilized between Q3 and Q2, says that these owners are just trying to raise rents, even though demand is telling us otherwise. Now, let's go look and see what each individual asset class is. We'll start with class A, move to B, and then to C. I'm going to go out on a limb and say we're probably not going to find very many class A in this market. and we probably have more Class C than anything else. And I'll be willing to bet that it's the Class C dragging this down, but I haven't seen it. That's just my assumption. Let's go see what the data tells us. So let's go look at Class A first. Here is the Class A rent analytic data. As I thought, there is only one property in the market that is Class A, and it is 172 units. If we look at the effective rent for this is very interesting. It is only $730 in the first quarter, up to $740 in the second quarter, $752 in the third, $764 in the fourth quarter. Let's look at the absorption for this property and see, and interestingly enough, even though they were increasing rents every single quarter, they had one more move out than they had occupied. Taking that was pretty low occupancy, or pretty high occupancy, very low vacancy for this property, and it is only at 97.7% at this point. So we cannot argue with the fact that they should be increasing rents, because this is definitely, especially for this market, too high of an occupancy. They probably need to get this down closer to about 92% before they start to stop those rent increases. So that's it for Class A. We only had one property to look at, and I thought that'd be the case in this market. So let's go take a look, and one property doesn't give us a story anyway, but interesting to see what the one property looks like. Let's go see what Class Bs tell us. Here's our Class B rent analytic data. There are 23 properties totaling 2,213 units, so we actually have some data to look at this time. Looking at effective rent, we started Q1 of 2022 at $873, up to $895, up to $904, and then a little slight break, basically stabilized down to $902. So let's go look at our absorption and see if it's telling the same story. And as we can see, much the same that we saw with the all three asset classes, where we had negative absorption all the way back to 2021 Q2, except for some occupancy in the third quarter of 2022. So right about 93% occupancy. So now is the point where they should start to lower those rents, and we're seeing that. So I think the Class B is reacting appropriately. Notice we had the 873, 895, 904, and then we got down to that 93 or 7% occupancy, and we had that break in price. So pretty much what I would expect to see, and that's starting to happen now. So for Class B properties, we are starting to see those rents trend downward, as we should at this vacancy rate, or the occupancy rate of 93%, even though that long-term occupancy average for this market is about 12% vacancy. So let's go see if the Class C market is telling the same story as the Bs. So here is the Class C rent analytic data. There are 58 properties totaling 4,254 units. Looking at effective rent, we started first quarter at $744, very slightly up to $748 in the second, up to $763 in the third, very, very slightly up to $765. One can argue that it is kind of stabilized, and we can see that in the square foot price, that it's stabilized from $763 to $765 from third to fourth quarter. Let's see what absorption's telling us. So we look at the absorption, and same as everything else. Matter of fact, other than this 37 units that absorbed in 21 Q2, we got to go all the way back to Q2 2020 to see any positive absorption in this market. So these renters definitely do not like what they see in these rents. There is negative demand, and the fact that we're seeing rent increases in all three quarters, with the rent stabilization in the fourth quarter at a 11.6% vacancy, 88.4% occupancy, is telling me that these owners are just raising rents because they believe that they can get away with it. But there is definitely negative demand in the Class C market for the Wichita Falls metro statistical area. So what does this mean for this market? Well, let's pull up that market cycle chart and take a look at it. We know that we are about 1.5% above the long-term occupancy average, so I'm pretty clear we're going to be in oversupply. We don't have any construction happening, so no new deliveries coming to the market. We are definitely seeing negative absorption across all three asset classes, and we're seeing very little rent growth. As a matter of fact, it was only negative, and I think in one of the asset classes. But we also saw that there was no demand in any one of those asset classes, but one of them was very high in occupancy. So market reacting appropriately in a way. I don't think it's reacting appropriately in the Class C. I think they should have broke on price much sooner. Class A was way over occupied, so we'll probably continue to see rent increases until that comes down on that one asset. And the Class Bs are reacting appropriately. We are seeing that break in price for rents going from third to fourth quarter, and we are right about 7% vacancy at that point. So Class B definitely reacting appropriately. So I'd put this market right here on the third point, inside oversupply, primarily because we are over that long-term occupancy average. So that will do it for the Wichita Falls metro statistical area in the state of Texas. Stay tuned tomorrow as we look at Bloomington, Illinois. Wednesday, we're going to look at Augusta, Georgia. Thursday, we will look at Portland, Oregon, and finish the week with Albuquerque, New Mexico. I will see you guys tomorrow.